SBI Card's net profit jumps 11%. NPAs improve. We caught up with Abhijit Chakravorty, MD and CEO at SBI Cards, to know more about the quarter gone by. Listen in.
Post increase in the risk weight sometime in November 2023, we expected that the rates will be going up a bit for us, impacting our cost of funds. And we have seen that happening in our Q4. It has gone up by around 20 basis points, we see. But then it deteriorating further for us depends on what the rate cuts come in place. All of us know that that has not happened, and we have not we expected that it's going to come soon as per the market estimation. If that is so, then the rates will remain on stable for us. And in case there is any increase due to market impact, marginal increase, we will be able to pass it on to our asset book. So not much of an impact beyond what expected, beyond what we have seen as per expectation after the regulation came.
Sure, sir. And with regard to when does it start to recover, and maybe a timeline vis-a-vis the repo also will help. So is it going to take a quarter post any repo decrease or reduction in the repo rate? Will it take a quarter or two for margins to start to improve? Because now it seems to be that margins have bottomed, according to you.
I won't say the margins have bottomed up, because as I said, everything will depend on how the ecosystem behaves. We are seeing it as stable. If there is any ecosystem impact, it can have an impact on our cost also. But as we go by what happens around us, so we expect that it remains, it should not become very adverse even in the short run or in the medium run. Largely, it will remain stable. And regarding RBI's actions or whatever guidance they give, we will not be able to tell.
Sure, take your point. Okay, understood. I want to switch focus towards outstanding cards and growth in cards. Just from a market share perspective, there's been a bit of a decline FY23 versus FY24. Is that also largely to do with how unsecured is behaving, how the asset book is behaving? Is that a strategic call to try and reduce or try and curb down on growth and focus on existing customers, or do you believe that this is a point of concern?
So we have grown during the year by 4.4 million new accounts. Now, that is significant. Yes, we could have grown a bit more, but then January 2023 onwards, when we saw there is a bit stress in the portfolio because of the ecosystem impact, we did take some corrective actions. We did take some decisions which had an impact on our acquisition strategies also. So all these taken together, this might have restricted some incremental acquisition, but then even after those corrective actions, we have still done 4.4 million cards, and this is what we will continue. We will continue to add 1 to 1.1 million cards every quarter, and based on what is our acquisition framework, within that, whatever applications we get and we find it acceptable, we will definitely take them up, and in that process, if the count goes up, we will welcome it.
Okay, understood. So this kind of a run rate clip kind of will continue. Point taken. And with regard to credit costs itself, what's the kind of visibility and where's the pressure coming from in your view? How are revolver rates evolving, and for how long do you expect this pressure to continue with regard to credit costs?
We had analyzed the portfolio around two to three quarters early itself during the previous year. And based on that, based on our algorithms and customer behavior profiling, and most important, offers behavior, we had analyzed each and every account, and that's where we found that there will be a probability of some of the customers not being able to pay us on time. And that's where we had given a guidance on what can be the credit cost like in the near term, in the coming few quarters. We had stated in the previous call also. We find that prevailing. Our estimations have stood in place, and um, during the year, we expect it to taper down. And that is largely going to happen with our new acquisitions for last 1 year have been behaving much better compared to the peers in 21 and previous years, 21 and 22. So once the mix improves, definitely it's going to give benefit to us. But since the current levels are going to continue for the short run, overall during financial year 25, we expect that it should remain above the indicative levels of around 7% and above we have stated.
Okay, so that pressure to continue. With regard to Opex itself, it's tapered in Q4. Is this seasonality, or can we expect this as the revised base from where Opex will largely flatten? What should the expectation on Opex therefore be?
The Opex and specifically the indicator cost to income is partly due to the seasonality because we had the festive season in Q3 where typically the cost goes up for us, and in the subsequent quarter it tapers a bit. And additionally, the corporate book which we had constructed based on the RBI guidelines that came in February, so to that extent also our cost part got reduced. So as we built up our corporate book again, the cost will be increasing, and it will stabilize around the previous levels of around 56 to 57% of the cost income ratio that will continue.
That's SBI Cards, and